A 0.25% rate move sounds tiny. Yet, it can erase billions from stock valuations, push bond prices down, and raise mortgage payments. It can even move the dollar before the Federal Reserve announces anything. Why? Because interest rates are the gravity of money. An interest rate is simply the price paid to use money over time. The Federal Reserve sets a key short-term rate that influences financial conditions across the economy. From there, the effect spreads into bank loans, credit cards, mortgages, and business financing. A quarter-point move sounds tiny, only 0.25 percentage points. But trillions in debt, derivatives, and company valuations respond to the same benchmark. That small change can alter borrowing costs and the return investors demand across the entire market. A stock represents a claim on the cash a company may generate in the future. Investors convert those future dollars into a value today using a discount rate. When interest rates rise, the discount rate usually rises too. Higher discount rates reduce present value, so investors may pay less for the stock today. Higher rates also make government bonds more competitive with stocks. Their yields become more attractive. If Treasury yields become attractive, investors can earn more without taking the same level of business risk. Stocks must then offer a better expected return, often through lower prices, to justify their additional uncertainty. Growth companies are often more sensitive because much of their expected profit lies years ahead. The farther away the cash flow, the more strongly a higher discount rate reduces its value today. That is why rising rate fears can hit high-growth technology shares harder than companies producing steady cash flow now. For existing fixed-rate bonds, price and yield generally move in opposite directions. If new bonds offer higher interest, an older bond with a lower coupon becomes less attractive. Its market price must fall until its return becomes competitive. When yields fall, the process reverses. Interest rates also influence currencies by changing where global capital seeks a return. Higher relative rates can attract foreign money into a country's bonds and other assets. That demand can strengthen its currency, although growth, inflation, and risk sentiment still matter. Real estate feels rate changes through mortgage costs, especially for new buyers. A higher mortgage rate means a larger monthly payment for the same loan. Affordability falls, buyers lose purchasing power, and housing demand may cool. Lower rates can reverse that pressure. Markets do not wait for the Fed's decision. They trade on expectations. If everyone expects a rate cut, prices may adjust weeks before it happens. When the cut arrives, reaction may be small because it was already priced in. This explains a strange market reaction. Stocks sometimes rally after weak economic news. Slower job growth or softer demand can increase expectations that the Fed will cut rates. Expected cuts can support valuations, even when the economic signal itself is negative. Markets price the next move. After 2008 and again in 2020, extremely low rates pushed investors toward riskier assets. Then, the inflation shock triggered aggressive rate increases, forcing markets to reprice the cost of money. Every possible Fed pivot then became a contest between hopes for cheaper money and fears of recession. Interest rates connect borrowing, stock valuations, bonds, currencies, and real estate because they set the price of money. And when expensive money slows spending, hiring, and investment together, recession risk rises. That is where we go next.